Everyone's talking about a crisis in commercial real estate. But if you're a sharp analyst, a crisis is just another word for opportunity. So today, we're not just going to look at the problem, we're going to build the playbook. We're going to deconstruct this massive CRE maturity wall and pinpoint exactly where the strategic plays are hiding.
First, let's just get our heads around the scale here. We are talking about a $4.8 trillion commercial real estate debt market in the U.S. alone. Now, this isn't just some big number on a slide. It's a systemic weight that is about to shift in a huge way. And really, understanding its sheer size is the first step to seeing the opportunity inside it.
And this is really the core of what we're talking about today. That massive pile of debt, well, it isn't coming due all at once. It's coming in these compounding waves. So instead of running from that wave, we're going to learn how to surf it. This is your guide to turning what looks like market dislocation into a real strategic advantage. So what does this wave actually look like? Well, the data here really shows that extend and pretend strategy in action. See, lenders got pushing off 2022 and 2023 maturities, just hoping things would get better. Instead, they've kind of created this multi-headed monster. We're looking at almost $1 trillion coming due this year, another trillion next year, and a potential peak of up to $1.26 trillion in 2027. This isn't a single event. It's a multi-year cycle of pressure.
Okay, let's get into the mechanics of this whole cycle. We're going to break down exactly why this distress is happening. And trust me, it's not always for the reasons you'd think.
Right, so here is the central paradox of this entire cycle. We are seeing buildings with stable income, happy tenants, rent checks coming in, and they're still facing default. How is that even possible? Well, the answer isn't in the rent roll, it's buried in the capital stack.
This brings us to a really key concept, the negative leverage trap. This is what happens when your loan costs more than the property actually earns on its own. Just think about the formula for debt service coverage ratio. It's your net operating income divided by your debt service. So if your income stays flat, but your debt payment doubles because of higher rates, guess what? The loan amount you can support just got cut in half. And that creates a massive funding gap when you try to refinance, pushing a perfectly healthy building into distress.
And this is absolutely crucial to understand. Not all distress is created equal. The office crisis, that's a structural problem. It's demand-driven. It's an issue with the asset itself. But the multifamily bridge loan crisis, that's a capital structure problem, driven by those high-leverage, floating-rate loans that were supposed to be short-term. Now they're completely underwater. You need two totally different playbooks for these.
So if the problem is really in the capital stack, the opportunity starts with whoever's holding that capital. And that trail, it leads directly to the banks.
This chart here breaks it all down. Now, while big players like Fannie and Freddie hold a lot, the single largest slice of this pie belongs to traditional banks. We're talking nearly 38%. Their balance sheets, their regulatory pressures, that's what's going to dictate the flow of opportunities in this market.
And this is where it gets tactical. This table isn't just data, it's your watch list. You see, regulators get really nervous when a bank's CRE loans exceed 300% of their equity. These banks, they're in what I call the 600% club, which puts them under immense pressure to get that exposure down. They are, by definition, your most likely motivated sellers.
And that regulatory pressure, it's probably going to get even more intense. This quote points to a really fascinating human element. A bunch of experienced regulators are retiring, which means newer, less experienced examiners are on the job. And what's the likely outcome of that? They'll stick to the book, no exceptions. That means more rigid loan classifications that are going to force these overexposed banks to act even faster.
Okay, so we've identified the what, the why, and the who. Now for the fun part, the how. This is your tactical guide for finding deals before they ever hit the open market.
This is just an incredible tool hiding in plain sight. Every single FDIC-insured bank files public call reports. So step 1, you go to Schedule RCN to find their non-performing loans. Step 2, you isolate the riskiest ones, that's the construction and development loans. And step 3, you cross-reference that list with our high concentration banks. Just like that, you've built a proprietary list of motivated sellers.
Now, here's a crucial point. A lot of these stressed assets aren't officially in default. They exist in this sort of shadow inventory. In multifamily alone, there's an $11 billion gap between assets that are identified as troubled and those that are actually foreclosed on. By finding loans designated as specially serviced but non-delinquent, which just means they're with the workout specialist but still making payments, you can start talking to lenders months before that asset is ever publicly for sale.
So what do these deals actually look like? This table breaks it down pretty simply. Note sales happen first, usually about 6 to 12 months before a property gets taken back. Preferred equity, That's a huge need right now, just to fill those refinancing gaps, especially in multifamily. And deeds in lieu? That's common when a sponsor just says, forget it, and hands the keys back on a troubled office asset. Knowing this timeline is absolutely key to positioning your capital in the right place at the right time.
So we'll end with this. The biggest wave of this maturity wall is still a few years away. It's going to peak in 2027 with over $1 trillion in debt coming due. The market is basically giving you time to prepare. You now have the playbook to analyze the distress, to identify the motivated sellers, and to source these off-market deals. The only question left is, where will you be?